Good evening. Welcome to Deal Street Asia's latest webinar. This comes at a time when most market watchers agree that the boom times of the last decade are unambiguously over. No single metric shows the magnitude of the current downturn more than the dramatic retreat in the revenue multiples of the technology businesses. We may not have seen such a slowdown like this in a long time, and we don't know how long this is going to last. We don't know how brutal it's going to be. And I'm going to be asking these questions to our panelists today. Our reporters have been documenting recent struggles companies have been facing with fundraisers. We're starting to see layoffs. And are these the first signs of a painful future awaiting many startups across Southeast Asia, China, and India? To discuss all of this and more, I'm joined by a set of four panelists. There's Rishika Chandan. She's the managing director of Venturi Partners. They just closed their debut fund at 175 million recently. There's Conrad. He is Hong Kong based. He's the founder and chairman of Strategic Holdings. They have a portfolio in Southeast Asia too. They're looking for I understand they're looking to raise a debut fund for this region. There is Peter Macmillan, he from DeFi, and Dimitra, he's vice president, GGV Capital, and GGV is among the largest investors, not just in China, but even globally. I'm going to start by asking each of the panelists to take just 30 seconds to introduce themselves and their firms. Rishika, you want to go first?
Okay. I think you're on mute, Rishika.
Oops, can you hear me now?
Yes.
Perfect, thanks. Hello, everyone. It's great to be here. So as Joji already introduced, I am with Venturi Partners. We're a consumer-focused growth stage fund, typically investing Series C onwards in India and Southeast Asia. Our sort of focus is exclusively on B2C businesses across these regions.
Yeah, thanks, Rishika. Conrad?
Okay, this is Conrad Sang from Strategic Holdings Limited, and thank Deals Street Asia again for inviting me to be on this panel. So we are an Asian-focused investment firm. We invest in Greater China, and then recent years investing more in Southeast Asia, which we have done 7 deals already in Southeast Asia. And we are active in the areas of e-commerce, fintech, healthcare, health tech, education, ed tech, climate tech, and consumer products and services. So look forward to sharing more with the fellow panelists.
Thanks. Dimitra?
My name is Dimitra, just call me Dimi. I'm from GGV Capital. We are a global venture capital and growth fund. We're multi-stage, seed to pre-IPO, sector agnostic, invest globally. We're able to invest anything from 1 to 100 million in a single check size, but historically, where we really love playing is at 5 to 35 to $40 million range, which is squarely in the Series A to Series C, depending on which region you're at. We're a team of about 90 team members globally with 30 investment team members covering the globe.
Yeah, thank you. And Peter?
Yeah, thanks. And thanks for having me on today. Yeah, so at DeFi, we're a global regulatory and compliance tech firm, and we provide solutions for many clients, but in particular, helping companies move through their entire sort of company growth market life cycle from seed financing up to IPO, beyond, and any exit they might take along that path.
Yeah, thanks to all the panelists. So to begin with, the Deal Street Asia reporters, we put out something called the Deals Barometer every month. We do it in partnership with DeFi, where we look at every single deal across the 3 regions that we cover, Southeast Asia, China, and India. And to kick off the discussions, I just want to spend a couple of minutes asking each of our panelists to give their take on the Q1 numbers. I'll start with China. So between January and March, Greater China-based startups completed we recorded about 363 venture deals. And the combined amount that these companies raised was a little over 12 billion. The quarterly deal value was almost half, from 24.1 billion in the same period last year in 2021. And the number of deals also declined about 22%. We had 464 deals in China, Greater China region in the same period last year. So Conrad, just want your views on this. Deal making in China has remained muted. investors seem a bit jittery. It could be a combination of factors. It could be the regulatory crackdown that's on the tech sector, the prolonged US-China trade frictions, and also the Ukraine crisis. But at the same time, we're seeing a whole set of that we've seen that the deal activity in several other sectors like self-driving technology, robotaxis, semiconductors and chips, EV batteries, logistics, biotech. Now that has remained at par with last year. So does this mean that deal activity in China remains intact, but what has changed is the sectors where investors are parking their money?
Oh, yes, indeed. I think to add to the figures that you just mentioned, Joji, on the deal-making side, on the liquidity event exit side, the numbers actually show a dichotomy between the domestic RMB market versus the US dollar market investing in China. So in Q1, right? So the A-share market domestic, they raised $28 billion equivalent in RMB. And that figure was up 138% year on year. So meaning that companies, there's still a lot of companies actually going to A-share market, primarily the Starboard in Shanghai and also the Growth Board, the Chinese in Shenzhen to raise money, raise RMB. So that was up a lot. But on the contrary, the Hong Kong Stock Exchange, where a lot of US dollar China-focused funds would actually use for exit, the funds raised was down 90% year on year to 1.8 billion. So which really shows a very sharp contrast as how international investors look at China versus how domestic investors look at China. So for the domestic investors, they just look at 1.4 billion population and what can be done there. So the sectors that you mentioned, as you said, the deep tech, semiconductor, biotech, healthcare, or renewable energies, they remain good. Because you have the 1.4 billion people hinterland that are going to use these products and services. So at least up to Q1, that is not much affected. But what will be interesting to see is what's going to happen in Q2. I think in Q2, because lockdown starts happening in some of the major cities like Shanghai and Beijing, and some of these cities, like as we speak, they're still not completely out of lockdown yet or movement restrictions yet. So won't be surprised if when the Q2 numbers come out, there will be even a more bleak picture. And depending on the progress of the Omicron or the China eventually relaxing the lockdown restrictions, until then, I think unfortunately the activities on both the deal-making side and also on the exit side will likely remain challenging. But one thing I do like to clarify on a lot of international investors' perception on the seemingly so-called regulatory crackdown on tech companies in China. And if I may borrow some history, actually, it's not the first time that you have seen governments actually trying to break down monopolies for some companies. So back in the 80s, for those if they've got experience, Baby Bell, the Bell was like dominant in the US telephony market, both domestic and also international. So that at that time, because the telephony market was like so dominated and monopolized by Bell, US government ordered the bells to be breaking up into Baby Bells into different regions. So that was like one of the instances that government used the physical hand to break up monopolies. And more recent examples is in the 1990s. At that time, Microsoft was like absolutely dominant in the, at least in the US IT market, like what we're seeing in Tencent and Alibaba today. So US government, again, cracked down on Microsoft and ordered the company to be broken down into two pieces. And we just saw Bill Gates running around trying to lobby and prevent that from happening. And luckily, he prevented that from happening. So up until today, Microsoft's still in one piece. So what I'm trying to say is that, okay, the headline news that the international investors see about China is that, oh, a lot of crackdown, regulatory uncertainty, and this kind of scary and all that. But we take a bigger picture, It's just basically they're trying to sort of like maybe to prevent some companies become too monopolistic, one, and two is to preserve the data security. And I think they have done all this, and we've seen all that reflected in the public market valuations for China-related stocks. And now they recently there's an official coming out saying that they will continue to support the tech platform and tech economy. So one can interpret that signal as probably the worst is behind us as far as the regulatory pressures are concerned. So the next thing investors, I think, talk about China or Greater China is that they should look back at on the fundamentals, and also on the ongoing, how long this COVID is going to linger, and then to reprice the deals and to look at the current valuations for both public companies or private companies, whether there's value to be had here.
Got it. Thanks for giving us a China perspective. Let me just come to Southeast Asia. If you look at the numbers for the first quarter in 2022, Southeast Asian startups actually raised about 4.2 billion in equity funding. This is up about 5.2% from the same period last year. And the performance was also supported by strong deal volume. We had about 310 deals in Southeast Asia in Q1. And this is the highest on record since we started collecting quarterly data. So Dimitra, let me come to you. So big picture, when we look at Southeast Asia, at least when you look at Q1 data, it suggests that there's a sustained appetite for assets in this region, despite a challenging global and regional macroeconomic landscape. What's your view?
Yeah, thanks for the question, Joji. I don't think we've only seen this in Southeast Asia. I think that as markets mature in the US and China, we're seeing that investors are looking for more and more exciting and more nascent markets. And so I think this year, even if you were to look at the Pakistani data, so the Pakistani ecosystem has been raising a lot of money from VC. And so I think that this is the overarching trend of investors looking for more nascent markets to invest in as the US and China starts to mature. But I would say that the private markets definitely lag the public markets. Depending on which period of time you look at, it could lag the public markets by anywhere from 6 to 12 months. So I think, just like what Conrad was saying, I think we need to see what happens in Q2 and Q3 because the public markets have only started to correct. And if the private markets lag the public markets by 6 to 12 months, we also have to bear into account regional differences within private markets, right? So you might see a correction a lot quicker in China and the US, and in the Southern Hemisphere, the Indian, the Southeast Asian, and the LATAM ecosystem might see a correction a bit later, even if you just compare them in that sort of private market space. So I think it's too early to tell. I do think that the overarching trend is for more capital to flow into the emerging economies in the Southern Hemisphere, so not just Southeast Asia, but India and LATAM. I think part of this is happening because of there's so much capital around, and as the global investors are coming to regions like Southeast Asia, it's making the business model of the regional and local early stage investors more viable, because the global investors are here to provide a step up in valuations at the Series C and onwards. And so for the early stage guys in Indonesia or Vietnam, or the regional investors in Southeast Asia, they can be more bullish and do more deals, because potentially the global investors, the perception is that the global investors might come and provide a step up in valuations. So I think that trend will probably continue on for the foreseeable future. But the next 6 to 12 months is going to be a bit rocky, in my opinion.
Got it. Dimitra, just a related question, because Southeast Asia was also coming off a record fundraising year in 2021. We saw 25 new unicorns in Southeast Asia last year. That's more than the total number of unicorns that Southeast Asia has created in the last 10 years combined. So do you think a lot of deals that were done in Q1 were deals that were actually finalized in 2021? Because it takes a couple of months since the deals, from the time it's finalized to sort of the deals to be announced. So are we still seeing that the cautious phase? Like, do you think that'll only be in, like you mentioned, Q2 and Q3 and Q4?
Yeah, for sure there's a lag, right? Like, I mean, when venture, you hit the nail on the head. When venture capital investors do due diligence, the legal due diligence process could take anywhere from 2 to 3 months, and then you sort of have an embargo period before you release the news to folks like Deals Asia and other journalists. So there's definitely a lag in time period. So when we look at the Q1 data, it's going to look very bullish, but in Q2 and Q3, I think the numbers are going to be a bit different. But I do think that I still believe in the region. I do think that valuations recently have gotten pretty heated. In no doubt, because there's so much capital, chasing very few high quality startups in various parts of the world, especially in Southeast Asia, with so much capital right now. That if you are, a decent startup, very strong founder background, decent product market fit, you command a huge premium. And so I do think that there is that supply and demand discrepancy right now in Southeast Asia, but I think it will correct itself. It has to, because the private markets almost always catch up to the public markets.
Yeah. Rishika, thank you for waiting. Let me come to you. Before I want to ask you on Southeast Asia, I want to ask you on to give our audience an India perspective. I'll just share some India numbers. In March, Indian startups raised about 4 billion in total. That's 10% higher than Feb, 68% higher than the corresponding period last year. Again, in Feb, they raised about 3.7 billion. That's a threefold jump compared to the corresponding period last year. And in January, there were about 199 PVC deals in India. Total value was 4.43 billion. Again, a huge increase from January 2021, when 2021, I think, was hugely impacted by COVID. So when it comes to India, Rishika, do you think the mega deals are skewing the numbers? Is it hiding the fact that entrepreneurs across India's startup ecosystem are facing a sobering new reality as investors, because they're spooked by the geopolitical events and the tightening monetary policy globally, as well as the volatility in the public markets, are holding back on signing checks?
Yeah, I think, Joji, I'd like to say yes and no to that. Truth is that when you break down the Q1 numbers of this year, in terms of how much capital was raised, what you see is that 45% of that capital that was raised was actually towards follow-on funding, or, as you said, mega rounds, right? And so there is a huge skew when you see where the capital allocation actually happened. And I think the other aspect, which you already touched upon, is the fact that the quarter also saw spillover effects of deals that were perhaps agreed to be done in the last year. And so there is a sort of artificial inflation as you look at the Q1 numbers. I think that, to Dimi's point, last year, for India was a mega year. Average deal sizes doubled from $12 to $25 million. And the number of overall deals in the market also doubled. There were the creation of a lot of sort of market defining companies. But I think, this year, Q2 and Q3 will really show us reality. And I think reality on ground as we speak to founders and other funds is that there is a cautionary approach that everyone is sort of waiting and watching to see what happens after Q1, when the impact of what is happening in the US, China, et cetera, starts to actually trickle down to the private markets as well. The other trend that, we're sort of noticing very clearly is a flight to quality. So, we're seeing concentration of capital where category leaders are starting to take away a large portion of the money that investors want to deploy. So there is a lot of capital available in the market, right? But with the cautionary approach, what happens is that your risk return curve tends to change as a result of which, investors are sort of flying more towards category leaders and sort of fundamentally very, very sound companies. So, and I think that distinction will become a lot more clear over the next 2 or 3 quarters, where the best will continue to raise capital, perhaps even at increasing multiples as we've seen, whereas the rest of the pack might see a slightly disproportionate negative impact.
Got it. Rishika, you also do, because as a firm, as a fund, you look at both India and Southeast Asia. In terms of founder expectations, in terms of talks about a possible funding winter, any big differences between these two regions?
Yeah. So I think the exuberance is certainly tempered. Now this depends really. The extent of that depends on the sort of stage of the companies, right? So what we've seen is that there is a higher impact of valuation correction on growth in later stage companies, such as which are more CD onwards, whereas the entire effect of what is happening in the markets has still not reached your seed and maybe A and B companies, right? And then when you sort of further split this by regions, India just being a more mature market in terms of company evolutions, what you will notice is that there is therefore a higher impact there just because you have more growth in later stage companies. And therefore we haven't fully seen that impact of valuation corrections or founder expectations having been reset a little bit in Southeast Asia yet. Having said that, I think a lot of founders that have decided or are currently in the market to raise capital will be facing a slightly new reality where investors are, including us, are going to focus a lot more on unit economics and robust business models rather than growth at all costs. So I think that sort of impact we will start to see very, very soon, if we haven't already.
Got it. Peter, let me come to you. We've heard from three investors, and I'm going to give you some global data. In 2021, venture investment globally was up 98% year on year, while the deal count was only up 27%. And a lot of these investments were actually driven by non-traditional investors, the hedge funds, the PE funds who were doing tech deals, mutual funds, and a bunch of other family offices. So all of these non-traditional investors. So, and the data points would say that non-traditional investors actually put in about $254 billion into the tech space last year. Do you see in the next couple of quarters a pullback from some of these non-traditional investors?
Yes, thanks, Joji. I think in the past few years, we've seen this trend. And I think as we've worked with different clients, more of these non-traditional investors globally have been part of deals that we've worked on. And as I said, clients we worked alongside on. And the early stage valuations have jumped as well, just to add to your numbers, according to research, about 50%, year on year, and with late stage going up maybe 30%. And obviously, a lot of these non-traditional guys have been coming in and they have larger pools of capital, maybe versus traditional VC funds. And, we've worked with them and we've definitely seen this valuation change occur as those numbers would kind of depict. But I think, as Dimitri said, as these investors come in, it's helped to boost the later stage valuations. So that's also provided more opportunities at the early stage. And I think these guys are probably part of that mix as well. And it's not surprising given that the demand for capital, the strong returns, and all these kind of things have really coupled together to provide a great pathway for them to step outside of what they would consider their normal traditional market. But when we've spoken to guys coming into this year, there's definitely still interest and the appetite is still there to continue to invest. And at the later stage, obviously there are concerns about the lack of immediate exits that are weighing on their minds. But I think the opportunity they see there is still fantastic. But as Rashika mentioned, I think they're looking for the companies that are going to be the winners or best in class. And there's a real flight to quality happening. So while they'll be pouring a lot of money into those companies, the second, third, fourth player in any particular market is probably not going to get as much funding. And that probably will lead them to step back slightly because there's only so much money that those guys can take on at any particular fundraising round. So it's going to be interesting to see how much they kind of have to pull back. But I said, from the ones we talk to and the ones we're working with, there's definitely still the appetite and they really want to get out there and continue to grow this part of their business. And we'll continue to look for those right opportunities.
Got it. I want to come back to some of these points a bit later. But before that, just want to take a quick look at the April data too. We saw the Q1 numbers. And if you look at April equity capital markets globally, they seem to be on a downward spiral thanks to a combination of interest rates, inflation, and geopolitical uncertainty. And technology companies, especially the listed ones, seem to be the most impacted. And IPOs are going nowhere. Many IPOs are getting unsubscribed. And crypto, that's seen a very early winter. So just looking at the data for the three regions, in April 22, it's slightly more busy month for Greater China. Total funding funding value was down by about 42% compared to the previous month. Year-on-year deal count was about 14% higher compared to April 2021. but the total funding value was of 2.7 billion, was less than half of the amount that the Chinese companies raised last year. India was also very interesting because April was of the first time in several months or in a long time that India did not see any startup enter the unicorn club. Southeast Asia, actually, the numbers were very good, and that was because of 3 mega deals in April. Koda Payments, Sky Mavis, and Voyage Innovations in the Philippines. Now, these 3 deals combined alone were worth over 1.1 billion. So that made April 2022 the best month for Southeast Asia. Dimitra, let me come to you first. One of the things that, again, specifically to Southeast Asia, if you look at the last couple of months, decentralized finance, that has been a sector that has done very well. There were about 30 deals in this space. Companies in the space raised about 223 million. That's 1/3 of the total number of deals. Another segment that has done really well was gaming. We saw in 2022, we saw 23 equity deals, and about 15 of them were by play to earn games that were powered by blockchain. How do you see these two segments going forward?
Yeah, it's a great question. As a fund, we're looking a lot more at Web3 these days, and we have started closing deals in this space. We have, however, been focusing a lot more on the infrastructure and middleware segment of Web3. Folks who are building node management, staking services, the social graph layer for Web3. We're focusing a lot more in that type of picks and shovels businesses. There is a lot of noise in things that touch the consumer in the B2C Web3 space. And I believe even the GameFi numbers that you have quoted to us, it's driven by 1 or 2 anomalies in this space rather than a more distributed type of funding. I would say that DeFi is a very interesting sector for us. When I look at, let's start with DeFi first, right? When I look at Web3 versus Web2, if you look at the Web2 world, the Wall Street and the financial services that has developed over the past 50 to 100 years has developed because of Main Street. Like the real utility and the real use cases came about before finance came about to serve clients in those use cases. Whereas in Web3, what's interesting is that finance, the banks, the DeFi has developed before the actual use cases has developed. And part of that is driven by huge financial utility funded by investors, where many of these DeFi platforms can offer you 20% yield on a token that is debatable whether or not it has any utility value beyond financial utility. So that's an interesting thing. And I think when that happens, it makes me question a bit more about how that is happening and why it is happening. So one of the biggest differences between Web2 and Web3 is that in Web2, you get what I call the cold start problem, where you have to find a way to give users application utility. And a lot of that is from network effects. I use Facebook, Joji, because you are on Facebook and we're friends, and we have 1,000 other people who are using Facebook. But in Web2, folks are bootstrapping the application utility with financial utility. Right, so that's one of the biggest differences between Web2 and Web3. And the fact that, like, if you look at each blockchain as a country right now, if you look at Ethereum as its own country, and there are all these apps developing in this country, like Ethereum has become almost like a financial city-state, right? If you are not a DeFi app today, like, can you really afford the gas fees on Ethereum? Can your users afford the gas fees on Ethereum if they're not getting paid 20% year a year? So I see a crowding out factor that DeFi has as an impact on Web3, that it has crowded out potentially some of the more useful apps that are trying to develop. It's a bit like, think about the difference between Shanghai and Shenzhen. If you want to open a factory today, you can't open in Shanghai because the rental cost is so high, because only banks and financial institutions can afford it. So you have to go to Shenzhen to open a factory, right? The same thing is happening in the Web3 space right now, is that we have many Shanghais, we don't have enough Shenzhens. We need to build more application utility into this world. So I love DeFi. I just think it's gone a bit way ahead of its time. And recently, with the spectacular collapse of Luna and UST, The total value locked has probably dropped by 40 or 50% on the DeFi ecosystem. So we'll see how that pans out. And then on GameFi, as of now, I'm a gamer myself. I play a lot of games. I understand the frustration of leveling up to level 100 and not being able to sell your avatars or your characters. That is frustrating, right? So we all want an interoperable world in gaming where we can put 100 hours into leveling up to level 100 and then we can sell that and can move on to the next game. So that is frustrating. But today I do believe that in GameFi, the games are not that fun, in my opinion, right? Like I'm there because I'm making money. But I think in the next 2 or 3 years also, you see a new generation of really fun game, very good graphics built on the blockchain, many of whom would have learned from the more flawed tokenomics of the earlier guys, and they would have built on that and build a more sustainable, play to earn versus play for fun population within a metaverse or within a game. And I think hopefully that will create a more sustainable GameFi games in Web3. So like I said, I think what GameFi and DeFi, both very interesting applications, but I think they've gone ahead of itself in terms of valuation and hype.
Interesting. Thanks, Dimitra. Peter, let me come to you, but shifting gears slightly, I wanted to look at some global data again in terms of, according to TechCrunch, total funding globally for tech in April was about 47 billion. Now, this is for the first time it's fallen compared to last year's levels. But as late stage funding becomes more difficult, do you see a lot more founders looking at venture debt?
Yeah, so it's interesting, Joji. So we do work with these guys looking at venture debt versus equity. And I don't know, when we talk to them, whether current market factors should really influence their decision as to what they take. Obviously there's a lot of positives towards raising debt. It can be a little bit more complicated sometimes, but there are other factors that, influence their strategy and whether it's right for them. I mean, of course, with debt, they go ahead and they own, but they're out on their own. They take the money, they've got to do the repayments, they've got to provide the, guarantees sometimes. And with interest rates rising, that while those repayments will seem small and compared to an equity exit and what that costs, it's still something that has to be paid here and now. And, it may not be physically possible to pay it if the market doesn't go right, or they're not allowed another fundraising round, or they don't ever get to that kind of equity exit event or whatever they're looking for. So that burden, when we speak to a lot of these guys, is something that they're always concerned about, and they much rather take equity. And certainly in Asia, I would say we feel as though certainly the guys we work with, it's mostly equity. The very, very few come to us and work with us on the debt kind of side. And, even on the debt side, there are still the equity warrants attached to a lot of these deals. So even if they do go through and they are successful, of course, it's nowhere near the cost of the equity, but there are other financing numbers that they have to pay out as a result of those. So, honestly, I think it's really a question that can only be answered by the individual founder, and to stay on their course, what their direction is, and do what's right for them and what they need for that kind of unique situation. But I think certainly, when we talk to people with the potential rising interest rates, that's always a concern. And I think, we've already mentioned here, what rates could go up to, and that will have a big impact today on what they have to spend out. So yeah, so I think it's still up to debate and really an individual decision.
Got it. But whether it's debt or equity, Peter, what's, from your experience, especially in this part of the world, how good have founders been in using data to tell their company story, into sort of using data to sort of show their, using performance data to sort of when they speak to investors?
Yeah, so I think, this is just not a trend, I think, for founders. I think it's everybody now is grappling with how do they use data effectively to tell their story. And, I think now going into any kind of pitch or any conversation, and certainly with the ones that we see, a company is likely to fall short in many investors' eyes if they don't have that data. Especially there's seems to be a much more increased dependence on models and assessments and everything that these data points are required to create a viewpoint or to create an analysis. And we help clients make and assess many, huge numbers of opportunities on a regular basis. And I'm sure the three panelists here are all very aware of, and have that same experience that they go through. So narrowing down that funnel and really wading through the hundreds that probably come across their desks is a large decision that they have to make. And from the guys we work with, it's very much data driven, and all the platforms and everything we work with and with them on is very much about using the data to ingest that and get to an analysis and a very quick kind of decision criteria that they can move on and then really analyze certain opportunities. So I think data is extremely important, and we've seen that come more and more into the pitches and everything. And I think it's not just the performance data that we talk about today. I think, there's additional concerns in today's market, where new data metrics are moving from nice to have to an absolute required capability. So for instance, ESG data, I mean, it's whether everyone agrees or not, whether you can collect it or not, it is a trend that's sweeping the world, and more people are asking for this ESG data. And we're seeing a lot of stock exchanges from that final listing kind of point, if that's what they're aiming for, Hong Kong, Singapore, from this region, who are demanding mandatory ESG reporting requirements coming up in the next few years. So it's going to be a critical component of that story and part of that performance that any investor is going to have to use to assess how that company is doing and where they're moving with these particular data points. And, we've all seen the stories of large asset managers, investors come out and talk about they won't assess an opportunity if it doesn't have relevant ESG data attached to it. Now, obviously, that hasn't probably pervaded down to the private markets and everything now, but it's going to be something in the back of their mind for all of these guys, I think, moving forward. And certainly something we're talking to clients a lot about, advising on how they move ahead with that kind of data strategy to align to their story. But I'd also say it's not just about the data that they're providing to their investors. I think nowadays there's a lot more, especially with the virtual world and maybe not being able to get face to face. I know we're coming out of that in many areas, but it's still, travel's still not, what it seems to be. And being able to analyze, what investors are actually doing. Are they reading my documents? What part of my document are they reading? How do I, are they actually interested in, and what are they interested in if I'm going to have a conversation with them? So I think there's also the opportunity through a lot of platforms for the founders themselves to really gather that information and really be aware of how they can put that story together better and what data points really matter to investors, and make sure that they're really producing a quality walkthrough when they're up against it and looking for that fundraising. So absolutely, I think data is more important now than ever before, and will continue to be so moving forward.
Got it. Rishika, let me come to you. Until last year, term sheet, shareholder agreements, they were very founder friendly, whether it was in Southeast Asia or in India. As times change and as it becomes more and more difficult to raise money, do you see terms, the term sheets change where we'll have new terms that promise investors all sorts of rights and features, more protections?
Yeah, I think, Joji, that the correction in the public markets, will inevitably put downward pressure on valuations in the private markets. Overall, I think investors are likely to price risk more stringently than the way we perhaps did it, in 2020 and 2021, where businesses were growing quite rapidly because of COVID, etc. I think the way to look at this is that the bargaining power has certainly shifted. But having said that, I think fundamentally good businesses that have products or services that can protect their margins and customers, like we said, category leaders or fundamentally strong unit economic businesses, I think they will still have pricing power and the ability to raise, and perhaps even more. I mean, just sort of throwing some data there, certain category leaders and consumer companies that we've seen in the first quarter of 2021 have actually raised capital at an expansion of a multiple. And that expansion is quite significant, I mean, maybe a turn to 2 turns more than what they perhaps did the last round. So as I mentioned before, those kind of businesses will perhaps not see any impact in terms of rights, terms, etc. Whereas for the other companies that need capital more urgently, for them, they're just investors will want to price uncertainty a lot more stringently than they perhaps did earlier. And given that there will be fewer investors and less capital flowing towards these businesses, I do think that there will be some sort of correction in the way rights have been negotiated.
Got it. Conrad, we had our panelists, including Rishika earlier, talk about the flight to quality. So does this mean that going forward, we're going to see much less tolerance for high burn without exceptional performance? And will we see investors looking at an increasing emphasis on unit economics and return on capital?
Yes, and maybe I've been in this industry long enough to see the cycle. So what we're seeing right now is just brings me back the memories of what happened in 2002, around that time, so 2 decades ago. So that was like after NASDAQ meltdown and a lot of public stocks in the US, the tech stocks fell 89%. So we were faced with the founders who were still in the mode of trying to create a story and get money from investors, because that's what they did in the late 90s. Very easy to raise money and then create a story without unit economics, grow at all costs, and raise a lot. So when things fell back to the ground, then I think what we are doing is that pretty much like what I was doing back 20 years ago, is that to coach the founders again. The world has changed. So you cannot just basically create a story hoping that you're lucky enough to have someone to fund you like what you did a few years back. So you have to restart, streamline your operations, focus on unit economics, and not even unit economics, because at the end of the day, if you can survive, it's more than a unit economics or CM1 or CM2 or CM3, whatever. It's actually you have to go down to assuming what you have on your cash and balance sheet is your last round of funding. How can you actually sustain the team? How can you become actually EBITDA positive? And that is actually a very harsh decision for founders who have been used to raising money during the hype times. But nowadays, we're actually entering winter. And I think as several of our fellow panelists have pointed out, we don't know how long it's going to last. And assuming that fundraising is getting challenging for VCs themselves, and that would trickle to fundraising being difficult for these startups and young companies as well. So maybe I go a little bit overboard, but indeed, when it came to 2003, 2004, I went to Silicon Valley, speak to the people there, and they were saying that, oh, at one point in time, back in the late 90s, I was worth like millions of dollars, but now I'm worth nothing because my ESOP just basically out of money and worth nothing. So they would like had a dream. So for the people who survive, even there are a lot of startups who survive. But the companies that survive and became good companies today, like we see, like Amazon, Google, and the likes, they are profitable companies. So I think the challenge now is flight to quality, one. Two is that it's just not just the unit economics. So if you're saying that people are trying to still price the deal based on price per page view, price to GMV, to less than price to sales, I think these metrics are starting to get shaky, if you will. So the choices faced with the founders is that, as I said, they either work on their own, they tighten the belt and do this winter, or in fact, I would encourage is that try to look for similar companies in your space or upstream, downstream, and do some consolidation. As an investor, I think they would like to actually see companies merge, or the companies become more concentrated resources so that they together can actually go through this winter easier. So won't be surprised to see a lot of more acquisitions and M&As happening from this point onwards. And even for some of our Southeast Asian portfolio companies like Kasam, for example, they've done a few acquisitions already in the past 2 years. And some of the companies, I think by the time when you see the data, right, Joji, and I think you'll probably report a lot more M&A activities from this point onward. Primarily, I think it's probably stock swap, but it's the way to go. That's reality.
Sure. Dimitra, let me come to you. Conrad spoke about M&As, but at the same time, going forward, do you think it'll take much longer for funding rounds to close, because everybody is in a price discovery mode, and there's also, you don't have the peg with public markets because the share prices of the listed companies are down. And related to that, will we also see a lot of creative deal making, a lot of M&As between growth stage companies encouraged by the investors?
Yeah, I think we cannot stop investing. You know, we can raise the bar on what quality is, but I think we cannot stop investing. So I'm a student of history and I love studying history. And so if you look at venture capital history, what happened in the dot-com bust in the 2000s. If you look at a lot of funds that were vintage mid-90s, maybe 94, 95, 96 vintage, and you're in the year 97, right? And you look at the market and you say, market's too hot. I'm going to take my foot off the pedal because it's 97 and market's too hot, right? And you would have missed out on the growth in 98, 99, and 2000. In fact, when the dot-com bust happened, many of the private investors, the VCs, had made their money because it was post their IPO lockup period and they had sold a decent amount before the crash happened. So if you were a vintage mid-90s fund and you looked at the year 97 and you tried to be smart and clever about it and you timed the market and you said, look, I'm going to take my foot off the pedal because I think it's smart, you would have looked like the worst performing fund in an LP's portfolio. Worse than bonds, worse than public equities, worse than gold, worse than real estate, worse than many other things, because you thought you were smart and you tried to time it and you said that in 97 it's too hot. You missed out on 98, 99, and 2000, where it accounted for pretty much all of your competitors' returns who had continued to invest in those 3 years. So one of the lessons that I learned from that chapter is that it's very hard to time the market. In fact, the private markets are probably harder to time than the public markets because of the illiquidity premium. So we cannot time the market. So I think as VCs, the benefit of being, me working for a fund that's been around for 20 years is that we have the pattern recognition across borders and also across time. And so we just need a consistent definition of what a good founder looks like. And then good times, bad times, we invest in good founders, building the right products, and with a path to positive unit economics. That's the only thing we can do, because if you try to time the market and we say it's too hot now, let's stop investing, we could be very wrong. But when you invest in good teams, bad times, they don't fall as hard, they get up faster and they start running again. So that's the only way is to keep investing with a consistent definition of what great looks like. That's what we're doing. So I can't speak for other investors. They might want to slow down, but for us, we have a consistent definition that's been built up over 20 years of knowledge repository, and we just have to keep going the direction that we're going. And if we see a good company, we're not going to slow down. We're going to, if it passes our benchmark, we're still going to invest. But I do feel like in the M&A segment, you could see a multiple. You could go either way, right? Like it could be that people have a cash crunch and they slow down. It could be that a lot of bargains around and people could be shopping for more. It could be folks that are potential acquisition targets have enough cash to tide them through bad times, so they don't feel like they have the need to sell. So I mean, it could go either way depending on the sectors in the market. So it's hard to tell right now. But definitely our advice to our portfolio companies have been that in the next 6 to 12 months, if you see anyone that are trading at a discount in the private markets, and you have cash on your balance sheet, you should consider.
Got it. Yeah, both Conrad and you had spoken about history. So just look at, the 2000 crisis or the, Rishika, let me just come to you. As I mentioned earlier, venture dollars last year were up 98%. That's very similar to what happened from 99 to 2000. It took 10 quarters from peak, for the sort of before things stabilized in the internet bubble in 1999, and 9 quarters during the 2007 crisis, the Great Recession, for things to stabilize. So does this mean that we are still 2.5 years away from the bottom?
I think, Joji, hindsight always looks perfect, right? But I think there is no sort of quantitative way that one can define whether or not this is the bottom or how far we are from it. If you look at what's happened to the NASDAQ, it's already down close to 40% and still lost 5% in one day yesterday. And so, the question is, are we at the bottom yet? Maybe, maybe not, right? I think from our perspective, the way we think about it is that there are real margin pressures that we're seeing, on companies as a function of both inflation and supply chain challenges, and that is squeezing corporate earnings as well as earnings for just regular startups across India and Southeast Asia. Now, the extent to which this will impact pricing, the extent to which this will impact the overall macro situation is really a function of how long the war continues, a function of when China opens up, etc. Right? I think one thing that we're noticing is that supply chains are starting to move towards India and Southeast Asia, which is which is good for both of these economies in the long run. And if sort of capitalized on in the in the right way and at the right time, this could have a very, very positive effect on both of these economies, in which case we perhaps are close to the bottom, right? So I think what I'm trying to say is that it's very difficult. I do not think that we've hit the bottom, but how far we are from there is really a function of how things play out.
Got it. Peter, let me come to you. From the conversation so far, one of the things that come out is like the private investment has been sort of directly correlated with the performance of the public markets. Now, based on that, we should assume that the correction that we are witnessing in the public markets that will soon start reflecting in the private market for the next couple of quarters. But at the same time, the dry powder that investors are, be it private equity, hedge funds, VC funds, now that's at a record high. So do you think this correlation will hold?
It's interesting. I think Dimitri already answered this question actually, but it's definitely a knock-on effect. I think if the public markets are down, obviously it limits exit liquidity and opportunities, and therefore as you go down through the stages from late, reverse back down to early stages, the enthusiasm to invest will probably, certainly at the later stages will be reduced, and that'll continue down if that public market continues to correct or not reach the bottom, as Rishika was talking about. So, I think from our kind of perspective, we haven't seen a massive impact on the early stage, because really it's 5, 6, 7 years away from whatever they might be aiming for. So it's impossible to predict what the market conditions will be in that point. And as Dimitri said, like, we continue to invest, and a lot of the firms we work with aren't stopping. They're still using their same kind of criteria, the same evaluation and analysis of opportunities, and they're investing in the ones that are right for them, especially that area, because they see that they'll be able to get to that exit at some point in the future. But we've definitely had some firms who have started to take this concern on board as well, and have maybe stepped away, as opposed to really thinking, oh, there's nothing we can do, we want to close up shop. Obviously I don't think anyone's at that stage, but they're certainly just putting their plans on hold for a bit, and rather than pushing down to maybe their third or fourth choice opportunity. Because as we've talked about, I think from a flight to quality, I think those top guys are still always going to get the funding, and they're always going to get the investor attention. But the decision probably is more, I'm not going to invest in someone who's not quite meeting my criteria that I might have done 12 months ago.
Got it. Just one final set of questions. We'll keep it short so that we can take a couple of audience questions at the end. Let me start with you, Rishika, in the sense that as public tech valuation drops, and we're seeing a lot of remote or hybrid work happening, borders are opening up. For smaller companies that have raised capital that are still private, is this an opportunity to sort of leverage cash saved from cost-cutting measures and hire the best of talent?
Yeah, no, absolutely. I think this is a great time for investors to find good investments and for companies to hire great talent. And I think leveraging on both is very critical. From our portfolio's perspective, fortunately, all of the companies that we've invested in have raised a good amount of capital very, very recently. So they're all very well capitalized. But our advice to them is also to sort of, go for more measured growth, focus on customer retention rather than more customer acquisition, and have a clear path to profitability. And I think the other thing is also just build on getting critical talent across various functions as and where is available. So I think I fully agree with you. I think this is a great market where great companies can also get created. And I think there is a lot of opportunity amidst all of this too.
Got it. Conrad, what's, apart from general advice like conserve cash and extend runway, focus on growth or focus on efficiency, what's your framework to founders for navigating times like this?
It varies from sector to sector as well. I mean, I think what you just mentioned, Georgie, is something generally that we advise founders to do. But it's just that in certain situations that are unable to do that. I mean, if they are in IC design, they drug discovery, they will have no revenue for years to come. So that's the toughest part that I think really takes a lot of conviction for the VCs to continue to back these companies through the down times, because even in good times, there will be 3-4 years before they see revenue coming in anyways. And tough times, the staff look at what's going on with the public market and maybe think of leaving and going for another, maybe more promising startups and all that. So I think other than the ones that you just mentioned, the founders, they should do is actually rethink hard how to hold the team together, because times like this, negative headline news, it really affects people's sentiment, especially staff mentality. So I would say that I would advise founders to rethink hard about how to retain your key employees. Money is one thing, but on top of the equity is one thing, but on top of that, how to make them feel like that the companies really have the future. The founder of the future is worth following you through this cycle. I think it's something, a bit of mentality work that needs to be done by the founders.
Got it. I'm just taking a question from Rahmat to all three of you, all four of you, in case. Do you have an order in terms of, between China, Southeast Asia, and India? Which region, what's your order in terms of will see the most growth in the next couple of quarters in terms of tech investments? Who wants to go first? Conrad, you want to start?
Okay, it's hard to generalize. I would say it really depends, again, but breaks down the sectors as well, right? So for Southeast Asia, I think still the consumer upgrade, consumer related technologies will still be, we're seeing a lot of growth there. There's no doubt about that. In China, consumption has kind of like tapered a little bit, but then you see the investments in the deep tech and the renewable energies, semiconductors and things like that going. So no general questions, because they're at different stages of economic development or industry development. So I don't know much about India, but India with such a big population also like in China. So I suppose anything consumer related would be also very robust.
Yeah, Rishika?
Yeah, I think just to add to that, right, I think, India and Southeast Asia are also very sensitive to inflationary pressures, just given where these countries are in the overall sort of landscape, right? And so I think as long as inflation continues to remain in check, both of these markets, Indonesia, India, etc., will see phenomenal growth in the next 24 months. But if inflationary pressures continue to pinch consumer wallets, I think that there could be a slowdown in spending, and then just the overall exuberance also dropping.
Yeah. Dimitra, just a quick question to you. As IPOs are delayed, especially in Southeast Asia, and share prices of listed companies continue to underperform, will we see a new generation of mafia executives coming out from these unicorns and funded companies, these listed companies like C Group, Grab, GoTo, and start their own ventures, join other startups? How do you see this play out?
Yeah, that's a great question. I feel like, if you're an operator and you're one of these companies, that have gone public from Southeast Asia, to be honest, you're probably fully vested already, right? So I think you're either like 70% or fully vested at this point. So, I don't think money is probably not the only reason that's keeping you there if you're still staying around, in my opinion. There has to be some kind of belief in the mission and the purpose of the company. I would say that folks who have left before the IPO journey has begun are probably folks who don't want to stick around. So I would say at this point in time, it's not, and if you were an employee that had joined maybe 2 years before the IPO or 1 year before the IPO, and you would probably have a higher exercise price on your options anyway. So over time, the way you value this versus how you should spend your time would have changed anyway, and it would be optimized over time. So I don't think the fact that the price has fallen itself is going to push folks away who still have unvested options. If you see my point, right? I think that the main thing going through top operators' mind, if you're a top operator and you're thinking mid to long term, next 3 to 7 years or so, the main thing that's going through your mind is this still the right company to be at? You're not really thinking about short-term gyrations, because I think in the short term the market is is a voting machine, and the long term is a weighing machine, and you want to be at what is a long term, a heavyweight company. And so as a top operator, I don't think you're thinking about, oh crap, my whatever stock is down, 20-30%. It's like just slightly above my exercise price. Should I stay here? I mean, I don't think that's what you're thinking about if you're a top operator. If you're a short-term operator, then maybe you're not suited for those companies anyway. So I think the main thing is still, is this the right company to be in? Is this the right opportunity for me as an operator, rather than the share price has dropped 40%? So is it worth me getting more options to strike? I don't think that's what's going through their minds.
Got it. We're at 3 o'clock. It would be great if our audience can stay on for about 5 more minutes so that we can take a couple of audience questions. Peter, my final question to you. How do you see the IPO market? Because that school SPACs have more or less collapsed. In Southeast Asia, the likes of Grab, they're trading at record lows. Go-to share price has slid 50%, and so is Bukalapak. So what's going to be the impact in this region because of the lack of liquidity through IPOs?
Yeah, I mean, I think that the IPO market's obviously struggled a lot, but I think, as Conrad mentioned right at the beginning of this webinar, that China itself is up something like, 138%, I think you said, Conrad. So it's like there are markets and venues that are able to take on and provide exit opportunities, just maybe not so much from the international investor's eye. But I think just from a general exit, and maybe being over optimistic compared to everyone else, but we've seen the first sort of green shoots of recovery. Certainly in the de-SPAC kind of market from the US side, there's been a lot more inquiries, a lot more deals being talked about, and a lot of these guys are still reconfirming that the pipeline for companies remains solid, certainly in the non-emerging growth kind of sector, but that should obviously help to increase the liquidity and just get the IPO market back on track. And we're still seeing companies in Southeast Asia in particular taking advantage of the SPAC framework from the US and getting their de-SPACs up and running. Some, they've already managed to complete that this year, and others are in the process, either early stage or coming up to the end of it. So there is still a lot of interest and a lot of opportunity to provide an exit there onto the stock market. And then I think if you couple that with the SPAC frameworks that have been implemented in both Singapore and Hong Kong, now they haven't taken off yet, but it's another opportunity and another venue or avenue, should I say, that people can take. And just looking at Hong Kong in particular, given it's probably it's the biggest kind of stock market in terms of IPO activity and everything. I mean, we've got a huge number of deals that are all primed and ready to go, and with the regulatory change in China, and I think also with the kind of delisting stuff coming from the US, it's the expectation is obviously when, not if. So hopefully, like all those we're going through, and I think if you read the numbers, there's over 150 plus, maybe even up to 200 deals just sitting there that are in various stages of their filing application onto the Hong Kong Stock Exchange. So there's a lot of companies that have got the desire, they're doing all the work, they're ready and primed to go. It's just a matter of an event to open up that market and go. So I think hopefully that will come back, and that'll hopefully renew some confidence in that exit ability.
Yeah, just a question from Alia. Rishika, do you want to take it? Her question is, how are VCs looking at burn rate, and what classifies as a high burn rate, and how do VCs want startups to balance growth and burn rate?
I think that's there's no sort of direct answer to what is a good burn and what is not a good burn. The way to look at it is unit economics, right? Is the company profitable at a per order or a per customer or whatever the product or services? Are you profitable at a unit economics level? And is it only the sort of fixed costs around staff and talent, etc., where which is causing the burn, which is just a function of creating more growth, and then over time, you have leverage. As long as those are areas where you are, or rather the reasons for burn, that's fine. But I think if there is burn involved on every order, and your contribution margin negative, or you're negative on every order, that I think is a concern, because it effectively shows that maybe the business model's product market fit has still not been achieved.
Okay, thanks. Dimitra, one question to you from the audience in terms of, if we see investment slumps, what's the impact for ecosystems in the infancy? For example, the Pakistan or Philippines or markets like these.
Sorry, what's the question? What's the impact?
impact if we see investment slums? How does it impact ecosystems that are still, just coming up in the infancy, like Pakistan or Philippines?
Yeah, I think you have to look at it by stage, So if the thing about these markets is that recently there's been a slate of regional and local VCs closing their fund 2 or fund 3. So I think at the seed to Series A, we are pretty well covered. The question is, will the seed or Series A VCs slow down their investments if the global VCs at the Series C, B, C onwards slow down their investments, right? Because then there's a timing aspect. You don't want to invest in something too early and then only to wait for 2 to 3 years later before a global VC comes in to give you that step up in your valuation. So it's more of a cascading effect, I think, and it depends on timing. But I think the seed to Series A will probably good for the next 9 to 12 months because you have a pretty decently strong ecosystem of local and regional VCs who can keep funding new ideas. It's just at that growth stage, jumping from the A to B or B to C, you need a global investor to come in, and if they raise the bar, it inevitably means that they will be doing less because they're doing higher quality deals. And then after that 9 to 12 month period, then what impact does that have in terms of affecting the incentives for the early stage VCs, right? Because they might invest less if the later stage global guys are investing less. So I think it depends on the timing, it depends on the market, it depends on the sector. I do think, to Rushika's point, that it's very important at this stage to manage your burn multiple. And a very simple way to look for startups, if fundraising is difficult, or is to manage your burn, right? And the way the burn multiple works is that if, like, say you burn about $20 million to get $10 million of net revenue, so your burn multiple is 2, right? Like if you look at SaaS companies in the US, you can kind of track what is a 25th, a 50th, or a 75th percentile. What is a good burn multiple for your sector and for your vertical? So I would say, like, pay attention to your burn multiples, which is how much are you burning to acquire $1 of revenue. And I think that's going to be very important over the next year or so, as the potential for VCs to cut down their funding and do follow-on investments get higher. As the probability of that get higher, it's very important to manage your burn multiples.
Got it. Just one final audience question. We're already 7 minutes past. So this is from Abhinav, and any of you can take it. Valuations are getting stretched because of large capital pools chasing limited quality deals. Do you think that this will keep valuations afloat despite what's happening in the public markets? Anybody wants to take this?
Okay, so here we already start to see private valuations start to adjust, and in private we're having some conversation with very high-profile startups. We're having raised a lot of money, and they're thinking of the next round. Either they're running short of cash, or they're doing this on defensive basis. And these companies are already talking about they would need to accept at least a flat round, if not a down round. So for the better performing companies or higher profile startups that have stronger fundamentals, they also face the challenge of one simple question is that for the investors, if they have both public program, private program in Southeast Asia, say, so I can invest in this non-listed company, very promising, high growth, blah, 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 blah. But we could also invest in GoTo or Grab, especially Grab has lost 80% of revenue. Sorry, of its market cap, and then GoTo has lost 40% of its market cap. So how to convince the investors to invest in something that has liquidity versus something that has no liquidity for at least a few more years, but they have to pay a higher price. So I think when it comes to this situation, valuation adjustments are happening, even for the stronger companies, and let alone for the earlier stage, maybe less resilient companies. So it's going to continue for a while. There's a time lag, I think, between public market and private market, but private market always catches up whatever the public market does. So I think it's something that I think ourselves as investors and founders need to be aware of.
Sure. I'm afraid we can't take any more questions. I want to thank all our audience for staying on. Thank you to all our panelists. So I would, to all our audience, thank you. And I would encourage you to be part of our Deals Barometer reports. Like I said, we track all the deals across the 3 regions: Southeast Asia, China, and India. So you get a complete breakdown on a monthly basis, and it's perhaps the best read to keep track of the deals landscape in Asia. We have another webinar coming up on June 9th. I would encourage you to join that. And finally, this year, we're going back to a physical event, our annual summit in September. The dates are September 27 and 28. We hope to see a lot of you at our first physical event in 3 years. Thank you again to my 3 panelists. Thank you, Rishika. Thank you, Conrad. Thank you, Dimitra and Peter, for joining us. We had a great session, a lot of insights. We will be carrying the entire transcript and the video on the Deals Asia website within the next couple of days. So look out for that. Thank you all for joining.
Thanks, everyone.
Thank you.